Recording in progress.
Well, hello and welcome to the first edition of the Reverse Mortgage Weekly. This is a weekly that I wanted to do to help educate people on reverse mortgage. So this is my first attempt at this. So we'll just see how it goes. You know, we're just going to wing it today and see how things go. So one of the things I wanted to do is try to reach as many people as I can to start educating people about this program. I mean, it's a wonderful program that has helped out just a ton of different clients, and in really a lot of cases, it can be a lifesaver for folks that are in retirement, that are looking to work on trying to increase their cash flow and things like that. So let me go ahead and share my screen here. Hopefully y'all can see my screen here. I guess we'll find out soon enough. You know, this is again, this is my first attempt. This is all new to me. So I don't know how it's going to turn out. I don't even know if anybody's going to see it. So it's kind of interesting to just talk in an empty room by yourself here. So anyways, so one of the topics that I get a lot with clients is who qualifies for a reverse mortgage? What are the qualifications? What do you have to do? Because everybody is so used to the same concept of how you qualify for a normal mortgage, for a normal forward mortgage. And of course, when you borrow money from anybody, or especially from a bank, you know, most of what they're looking at is assessing risk. Okay, if we lend you this money, how are we going to get it back? Are you going to pay us because you have the income, the assets, and the credit to pay us back? Or how are you going to pay us back, basically? And that's kind of the cold, hard world of financing in general, is that they're assessing risk, and that goes with any bank. So with a normal mortgage, what they're assessing is, okay, we lend you this money, you know, 300, 400, 500,000. How are you going to pay it back? So how do they assess that risk? They look at your income to see, okay, we're going to lend this money out to you at this interest rate for this amount of payment. You also have other obligations, like maybe you have a car loan, maybe you have student loans, maybe you have a credit card, maybe you own a motorcycle or a Lamborghini, or whatever the case may be. You have obligations. Those also include taxes and insurance. So one of the main things that they're going to look at when they're qualifying you for a mortgage is your income. The other thing they're going to look at is your assets. You know, that's based on if you're putting a down payment on a property, or if they just want to see that, you know, if something were to happen or you lose your job or something, do you have enough money in your bank account to hold you for a certain amount of time? So that's the second thing that they're going to look at. And of course, your credit. Really, that's the three pieces that they're going to look at. And with the credit, they're going to determine if you have a good credit profile. I mean, if you are, you know, applying for a loan and you owe everybody and their mother, you know, funds, you know, it's going to be a little bit tougher for them to warrant you getting qualified for a mortgage. So it's something that they're doing to assess risk. So on a traditional mortgage, that's how they're assessing the risk: your income, your assets, and your credit. Now, the different piece to the reverse mortgage that is unique to any other mortgage is the fact that the payment is optional. So what does that mean? It means that, you know, you can make a payment on a reverse mortgage if you want, but they're saying it's optional. You don't have to if you don't want to. And that's really the big piece that is very helpful for a lot of folks, is the fact that if you are paying a mortgage, and in my opinion, if you're 55 or over, you should not be paying a mortgage payment again. Again, if you're 55 or over, you should not be paying a mortgage payment. And the reason is that housing is our biggest cost for anybody, for myself, for anybody who sees this video. Housing is going to be the biggest cost for your mortgage, so, or for your monthly expenses. So the ability to eliminate that cost is a big deal. Now, there's a few ways that you can eliminate that cost. One is you could pay your mortgage off cash. You could just pay it off and, no big deal. It's paid off. You don't have to worry about making a mortgage anymore. The other way that you can do it is if you are still paying on a mortgage, and many of my clients that do the reverse mortgage still have a mortgage payment. And that's one of the main reasons people are doing these loans, is that they want to get out from under that mortgage payment each month. They want to age in place. They want to be able to experience a great deal of freedom in their retirement. And the best way to do that is to start removing expenses, mainly because we're not making as much in retirement as we have been previously under some of our other job sources or things like that. So to eliminate that mortgage payment is a big deal. So why do I go through that whole long, explanation as to why you don't want to pay a mortgage payment? Of course, no one wants to pay a mortgage payment. You can with a reverse mortgage if you want, but it's optional. So why do I go through that whole explanation? Because how are they assessing risk? There's no payment. So how do they assess the risk on how are you going to pay back the reverse mortgage? Because with the normal forward mortgage, that's the main piece of it. That's the cornerstone of their risk, is the payment. If we lend you this money, can you afford the payment, basically? So if there's no payment, how are they assessing risk? So there's two ways that folks are assessing, that the banks are assessing risk with the reverse mortgage. The first piece is your equity. So they're going to take a look at how much equity that you have in your home, and they're basically going to assess the risk based on that. The second way they're going to assess risk is based on your age. So, I have a lot of folks who will tell me a little bit about their situation and say, okay, well, how much do I qualify for? Well, it's really tough to know exactly what people will qualify for on a reverse mortgage just off the top of your head. Generally, it's 45 to 55%, but we really don't know 45 to 55% of the total value of your home. So the way that we qualify and assess risk is through your equity and your age. Now, these are much like life insurance policies in the sense that there are actuary tables that are involved with these. So, so what that means is that the younger you are, the less access you're going to get to cash. So for instance, if you're a person who is 55, will get less access to cash than a person who is 75. So depending on your age will tell you how much you qualify for a reverse mortgage. And what we generally will do is take an assessment of each client. And, I'm a big proponent of really just finding out what my clients want. What's your goal? What do you want to accomplish? And then we kind of work backwards from there. We can kind of create a game plan to basically find out exactly what you need, what you're looking for. So the first thing with a reverse mortgage that you would need to qualify for is age. They're going to look at that. The HECM programs, whenever you hear the word HECM, that stands for Home Equity Conversion Mortgage. So that's the FHA program. Now, there's not just the FHA program that's available. There's several different programs that are available. There's about 9 different reverse mortgage programs out there, depending on how you want to get paid back or how you want to access your equity and things like that. So the first thing is they're going to look at your age. You have to be at least 55 years of age, 62 for the HECM program, the FHA program. That's the first requirement. The second requirement is that you have to live in your property for 6 months and a day. So what does that mean? Does that mean that you have to stay in your house all year? No. Actually, I have several clients right now who want to snowbird. Some of us don't like to wake up to a big pile of snow in the driveway, in the wintertime. So what do? Well, maybe you live here 6 months and a day, and then, or for 7 months, and then for the other 5, you live in Puerto Rico or Panama or Costa Rica or wherever you want to live, Texas, a place where there's a little warmer climate. So I have a lot of clients that will actually take money out of their current residence so that they can purchase a second home and be snowbirds. And the beauty of that situation is that, again, when you take out money on a reverse mortgage and get access to that cash, there's no monthly payment that you're required to pay. There is a monthly payment, but you don't pay it until you leave the property. So that's the big difference between a forward and a reverse mortgage in regards to payments. So first, again, you must be 55 or older. Second, you have to call it your primary residence. So you have to live in the property for at least 6 months and a day. The FHA program, and there are conventional programs as well. FHA programs, you have to be 62 or better. You need equity or a large down payment. Again, that's the biggest deterrent that I see from folks trying to do a reverse mortgage that are not able to, is just the simple fact that they need equity generally to do a reverse mortgage. So you're going to need anywhere from 45 to 55% equity in your home to do a reverse mortgage, because remember, they're not getting a monthly payment. They're not asking to get a monthly payment. So the bank is assessing their risk in the sense of not lending out the entire amount of your equity. So they're going to be anywhere from 45 to 55% on that. So there are minimal income qualifications. It's not as if we're not going to look at your income at all. There are, just like a VA calculation, on all VA loans, we have to do what's called a residual income calculation. What does that mean? Well, it means that the money that you bring in each month through Social Security, through pensions, through your job, if you're still working, whatever funds you have coming in retirement, we have to take a look at your cash flow to ensure that you can pay your taxes, your insurance, your HOA, and the maintenance on your property on a monthly basis. So very minimal income qualifications, but they are going to look at your income to make sure that you can cover those four amounts, those four expenses, basically. Now, I've seen a lot of folks, this is a step that is often missed in our industry. Most folks will just take a look at your age. They'll take a look at the value of your property from some sort of online estimate and spit out these approvals. Oh, you're approved, you're approved, you're approved. And then they get it into underwriting and they find out, oh, maybe I missed that part. Maybe I should have looked at that a little bit earlier or something like that. That's something that you want to ensure whoever you're working with is looking at that up front, because that can have a big impact on your approval. Now, let's say that the other thing that they're going to look at is they are going to do some credit inquiries as well, and they are going to look at your credit. Now, if there are issues with missed payments in particular, especially if it's a mortgage, they're going to look at that and they're going to see, okay, well, this person has missed a few car payments, they've missed a few mortgage payments, and if your score is really low, they may look at that and say, okay, well, we're going to have to reevaluate this. So what happens when they reevaluate the situation? Let's say you do not make a lot of money and your income, your cash flow is really low, which is the main reason a lot of people are doing these, is because their cash flow is low in the first place. But if it's so low that your taxes, insurance, and maintenance on the property, HOA, are not going to be able to be paid, they're going to ask you to, or they're going to put in place what's called a loan expectancy set aside. Now, what that is, it's a real big fancy name for an escrow account. Most people have escrow accounts, but these work much, much differently than they do on a forward mortgage. On a forward mortgage, the escrow account that you're getting put together is for your taxes and your insurance on a monthly basis. So you pay your payment, then you pay your taxes, and then you pay your insurance on top of that. So a lot of times you'll hear mortgage people refer to your payment as a PITI, which is principal, interest, taxes, and insurance. So with a reverse mortgage, when they set up that escrow account, or it's called the loan expectancy set aside, They're basically saying that you may have some credit issues or you may have some cash flow issues. And what that means is that they want to make sure that if they approve this loan, that you're going to be able to have your taxes and insurance covered. And if it's determined that your credit is questionable and you may not be able to make those payments, or quite frankly, for lack of a better term, if you have bad credit, I know it sounds hard and harsh, but they're basically, they may not trust you to make those payments. So they're going to make those payments for you for the next several years. And it's going to be different for everyone in regards to how they calculate your loan expectancy set aside. But generally it's for at least 10 years, could be up to 20 years that I've seen in some cases. So the reason I bring that up and the reason I wanted to put this video together were two reasons. One, so that you would understand how people are looked at and who qualifies for a reverse mortgage. But secondly, to show how they assess risk in this. And if they have to put a loan expectancy set aside, they call it a LESA account, L-E-S-A, loan expectancy set aside. So when they put that together, what they're going to do is that's going to take a big chunk of what you qualify for, and they're going to add that on to the loan amount. It's not going to be an actual, like, it's not going to be added onto the lien, but they're going to make space for that set aside to be put in place. Now, sometimes that can affect our ability to qualify. So for instance, if we have somebody who owes $200,000 on their home and their house is worth $450,000, traditionally, we would be able to pay off, depending on their age, again, we would be able to pay off that first $200,000 with a reverse mortgage, no problem. We turn the payment into an optional payment, so you're not required to make a monthly payment anymore. That works out incredibly well for most retirees, because then they can free up all of that cash that they're using to make that monthly payment. Well, they no longer have to make it on a monthly basis. They can make it on an optional basis if they would like. And most people choose with a reverse mortgage, they want to age in place as long as possible, live out their golden years in their home. They'll usually pay that loan off when they vacate the residence, either through a facility or through passing. But what that loan expectancy set aside does is they have to make room for it. So in that same scenario, a person who owes $200,000 on their home and home is $450,000, we can usually pay off that $200,000 no problem. But if we have to put a loan expectancy set aside on that approval, now they may add, and I say they, the bank, they may add another $80,000 that they want to put. And this is not, 80,000 is just a ballpark figure. I'm just throwing a figure out there. It's not specific. If you want specifics on a situation, feel free to give me a call anytime. I'm happy to run through a specific scenario for you. But in this scenario, just giving an example, let's say if they have to put another $80,000 on top of that $200,000, now you would have to borrow $280,000 to pay off that $200,000 with the reverse mortgage. Now, that obviously is going to create some issues in regards to, they may require that you bring money to closing on a reverse mortgage that requires a loan expectancy set aside. So that can sometimes be counterproductive. I've had clients that are okay with that though. They have to bring in $10,000, $15,000, but they know that they're not going to have to pay that $2,000 mortgage payment any longer. Well, they're going to make up that in a year, 2 years time. They're not going to have to, the benefit of not having to pay that monthly outweighs them having to bring money to the table. So just to recap, the basics with a reverse mortgage is that you have to be at least 55 or older to qualify. They are going to do some light qualifying. So they're going to do income, they're going to use your income going to use your assets. Assets can be used as an asset dissipation, things like that, basically income. And credit is another way that they're going to look at qualifying you, but it's much, much, much easier to qualify for a reverse mortgage than a forward mortgage, in my opinion, just because they're not looking at all of the risk assessment because there's no payment. They're not requiring you to make a payment. So a lot of times that helps out. If you have any questions, you can always reach out to me. I do this every day, all day. I'm going to start doing this weekly. This is kind of my guinea pig session, so we'll see how it turns out. But if you have any questions for me, you can always give me a call. I'm Zach Smith at Chariot Financial, and I hope to see you next week. I'm going to try to do this every Thursday at 11, right here from the beach. No, I'm actually in my office in Lakewood, Colorado. So anyways, I hope you learned something. And if you didn't, you can always give me a call. And again, you can bounce stuff off me. I'm happy to be of service. Thank you so much. We'll talk to you later.